Well, I think there's something important. Let's assume the LBMA are right, and I think they are in this saying it's a misconception that Basel III is changing it for gold. Therefore, what everyone's saying is that gold has to move into the banks for physical. That's rubbish. So I mean, there may be a vested interest in saying that because obviously gold is leaving London and going to New York, and a lot of people are saying it's going to New York because the banks want to have the physical allocated gold in their vaults ahead of Basel III, so they can count it against their reserves. Which now LBMA is saying that's not true. So that begs the question, why is all the gold, if it's not true, why is all the gold going to New York? Who in America is taking delivery of all the gold? You know, it's not what we thought, or it's not what some people suggested. It's certainly not the bank saying we've got to have gold in our vaults anymore, because that's not necessary if this, what they write, is true.
Some investors were puzzled by the 5% drop in gold prices, a decline in tandem with stocks after the U.S. announced its country-level reciprocal tariffs. Ordinarily, gold is seen as a haven, strengthening at times of volatility and when equities sink. Amid rising speculation online, the London Bullion Market Association has clarified that gold is not being reclassified as a Level 1 high-quality liquid asset under Basel III regulations on July 1st or any other upcoming date. Financial expert Clive Thompson questions the LBMA's claim that nothing's changed for gold under Basel III and why so much gold is moving from London to New York. If it's not regulatory-driven, Thompson asks, who in the U.S. is accumulating all this gold and why? From December 2024 to March 2025, traders increased gold shipments to the U.S. to protect trading positions on the Comex floor against the risk of U.S. tariffs. In his assessment, Thompson notes an unprecedented surge in Comex gold deliveries, with volumes over 700% in May alone. He highlights the mystery buyer, likely a major institution, quietly stockpiling 100-ounce bars. Since the U.S. election on November 5th, gold traders and financial institutions have quietly shifted around 24 million troy ounces into Comex vaults. Clearly, someone's not feeling great about what's ahead. With total gold stockpiles in Comex storage now hitting 39.15 million ounces, that's almost the highest level in 35 years, beating even the pandemic panic of May 2020, when everyone suddenly remembered gold doesn't default or need a bailout. From a technical perspective, Thompson speculates the buyer could be Berkshire Hathaway, citing Buffett's distrust of fiat and large cash holdings. He also suggests that U.S. bullion banks may quietly replenish gold for the Treasury ahead of a potential audit. After reviewing BIS rules, Clive Thompson explains that gold only gets a 0% risk weight, like cash, if it's backed by matching liabilities, clarifying that this condition is likely confused. Before diving into Clive Thompson's sharp insights from his latest interview, hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market.
What I was noticing was the Comex deliveries. So every single month this year, January, February, March, April, and May, the deliveries of physical gold bars under Comex are more than 200% higher than they were for the same months a year ago. And in fact, this month, the month of May, we're already halfway through it, and the deliveries are 700% higher than the month of May last year. So the puzzling thing is, this has been going on for 5 months, and we do not know who is taking delivery of these bars. But someone out there has taken the decision to get delivery of 100-ounce bars. This is sort of 300 and something thousand dollars each. So this is not mom and pop. This must be a big player or big players. They're taking delivery, and they're staying mum about it. They're not talking. They're not saying it's us. And anybody who's in the know is no doubt sworn to secrecy and keeping their mouths shut. So there's lots of theories as who could be taking delivery, ranging from the U.S. government to Berkshire Hathaway to big hedge funds. We don't know. It could be Canada. It could be China. I mean, I think it's unlikely to be China. Why would they buy gold out of New York when they could buy it from London? But long or short of it, someone somewhere is demanding an exceptionally large amount of 100-ounce bars from Comex. And I guess I'll let your viewers put their speculations in the comments as to where it's coming from, but I really don't know. I can only guess. Here's a little bit of a conspiracy theory for you and your viewers. There are widespread rumors that China owns a lot more gold than they're owning up to. In other words, they have a huge ton of gold they haven't told anybody. The reason they would want to have so much more gold than they're telling people is when the system fails, they want to be the leading seat at the table with the most gold to reset the system and write the rules rather than have the United States do it. But maybe the United States knows that through their secret service and their spying and so forth. And therefore, the United States is trying to outfox the Chinese by secretly acquiring a whole bunch of gold so that when time comes down to sit down at the next Bretton Woods or whatever they have to agree a new world monetary system, America says, you don't have the most gold, we have the most gold, so we set the rules. Could be. Article which came out a day or two ago, I think it was, from the LBMA, basically saying nothing's changed for gold. I found it rather surprising because the internet is literally awash with hundreds of articles saying, or in words of one syllable, that gold is a tier one asset and it's changing under Basel III, and banks want to hold allocated gold instead of unallocated gold and so forth. Whereas they seem to be saying more or less the opposite here, the LBMA correction. So I thought that was rather strange. So I went to this morning. I spent some time on the Basel, the Bank for International Settlements website, trying to figure out which way the wind blows. And I searched for gold. I searched for Basel III and looked through the regulations. Now, the rules and regulations are, I'm going to say, hundreds of pages long. It's very complicated stuff. But I could do some searches on keywords, and I also ran some of it through AIs to see what I'd get. First of all, I'm going to say I think possibly the LBMA are right in what they're writing, that gold is not a tier one asset. Although, funny enough, I see in what the LBMA are writing, they contradict themselves in the second or third paragraph where they say gold is a tier one asset, which kind of confuses me. But putting that to one side, I don't think there's any, technically, I don't think there's any such thing as tier one assets. Tier one is to do with your capital and your reserves. I looked at the Basel website. I found a clause which I think is where the original confusion may have arisen. This is clause 20.110, and it's a very short one. I'll read it to you. It says, and I read it slowly so your viewers can absorb it. The standard risk weight for all other assets will be 100% with the exception of the following exposures. 1, a 0% risk weight will apply to cash owned and held at the bank. In that respect, they appear to be putting cash and gold bullion into the same bucket. It says gold bullion held at the bank, and then there's some extra words, blah, 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 blah. And then it finishes off, to the extent that the gold bullion assets are backed by gold bullion liabilities.
What does that mean?
Well, it kind of says, provided you don't, if you've got an asset on one side and a liability on the other, you can set them off one against the other. You don't count your gold asset as a risky asset if you have a gold liability, because the risk on the liability side is the same as the risk on the asset side, so one cancels the other out. So I think that's what they're saying. Basically, it's not the same as cash if you hold it unless...
Signaling severe financial stress, Clive Thompson notes global 30-year bond yields are nearing multi-decade highs despite rate cuts. He warns rising yields will inflate deficits and likely force central banks to intervene. A monetary reset is coming, possibly involving gold, and Thompson urges buying gold now before it becomes scarce. U.S. Treasury bond yields rose sharply on Wednesday, despite the latest inflation report showing that price measures in April were unchanged on an annual basis compared to March figures. Bond yields will likely continue to be volatile and pressured higher. In this shifting environment, investors should consider alternative assets such as gold. Not every climb is smooth, but Thompson reminds us that gold's price naturally fluctuates. He views the current dip as a brief pause before a strong rebound that could surpass recent highs by year-end. Seizing the moment, he's personally added more gold during this pullback. Let's get back to the interview.
Around the world, Western bond markets, particularly the 30-year, which is a very long-dated bond, they're all flashing red, which is a danger sign. And when I say they're flashing red, despite governments having cut interest rates, or the central banks having cut interest rates in almost every country the last year or so, the 30-year bond yields are literally at as close as makes no difference to the highest level ever. So whether we look at Australia, Belgium, Canada, I'm looking at a chart here, Germany, Spain, European Union, France, Great Britain, Italy, Japan, Netherlands, United States, all of them are very, very close to the highest. I won't say the highest yield ever, because I don't know what the highest yield ever is, but they're very close to the highest yield in the last 5 or 6 years, or maybe 20 years. And it looks like we're about to have a blow off in the yields, and the yields go higher, probably in the United States, where we could easily go to 5% in the short term. We're at 4.4 or something like that at the moment. Japan is looking particularly precarious with the the yield's not a high level, but it's just gone straight up and up, and that's dangerous for Japan because they've got a very high level of debt versus GDP. So as the interest rate on these long-dated bonds rises, it means that they're refreshing their old debt, which was close to zero in interest rates. They're refreshing as it matures at these much higher rates, maybe 10 times as high in terms of interest rate. And that's going to start to bite and eat and cause the budget deficit to swell even faster. And the same principle applies all over the world, because almost every country has an average yield that they're paying on the debt, which is much lower than the current yields that you see in the marketplace. So I think we're entering a very danger zone, and we might get to a situation where there is no choice but for the central banks to step in and buy the bonds being issued by governments that the public. There's no doubt in my mind that at some point before this decade's out, we're going to have some sort of monetary reset. That can take many, many forms. And one of the forms might be some kind of new gold standard. But when people know that's happening, you will not be able to buy gold anywhere. In fact, you won't be able to buy anything which lasts. People will be buying stuff even though they don't need it, because they want to put their money into things which will come out the other side of the reset and still have a value. So, what I'm trying to say here is, if you want to be sure that you can come out the other side of what's coming, you better buy your gold now while you still can. I can imagine that perhaps some of your younger or less experienced viewers are disappointed that gold isn't going in a straight line towards the moon. No asset on the planet ever does that. Every asset on the planet, whether it be a bull market or bear market, has its ups and downs. And at the moment, I see that we're in a short-term. Well, I suppose it's short. It is short-term at the moment. It might turn into long-term, but it looks like it's a short-term downwards trend, and that obviously can continue for a little while. But given that the long-term trend remains up, I believe that this short-term trend or downwards trend will reverse itself soon. So probably I think we will be the long-term upwards trend continues, simply because the long-term downwards trend of money will definitely continue, because they're going to print more, especially as we get especially as governments are running budget deficits everywhere on the planet. So it's only a question of time before the upwards trend in gold continues. So I think it's quite likely that we'll be ending the year at levels which significantly exceed the all-time record that we've seen earlier this year. So I'm not too bothered. In fact, just to tell you, Mario, just this week, and the week before as well, I showed you, but this week I bought myself another gold coin here I went to Degussa to see what they'd got, and they've got a number, but a very nice. This is two kangaroos fighting. It's they're called Australian nuggets. They're £100 coins. $100 coins in gold. So I think the downtick in the gold price presents a little bit of an opportunity for those who've been saying, "I'll buy on a dip. I'll buy on a dip." Well, here we are. We're definitely in a dip. I don't know if it's the bottom, but if you are one of those people who say, "I don't want to buy at the highest price ever," well, here we are. We're not at the highest price ever now. We're several $100, $300 or $400 below it. Here's your opportunity, but you better hurry up, because it might not be there tomorrow.
In 2025, the U.S. Federal Reserve's monetary policy, geopolitical tensions, and central bank demand will shape gold's outlook. In the event of a recession, Goldman Sachs research forecasts that gold could rise to as much as $3,880 a troy ounce. Do you think we are on the brink of a major shift in the global financial system? And how will gold's role evolve in the coming years? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.